Good morning, you magnificent melon heads. Today is Thursday, February 23rd, 2023, and it looks like stocks are right now set to gain back everything they lost yesterday and then a little bit more. The big story for the whole second half of yesterday was those Fed minutes. And well, the Fed minutes came out. I think the market, a lot of the doves were probably, I should say the bulls were hoping for dovish Fed minutes. And well, they didn't get them. I didn't think the Fed minutes yesterday were really particularly hawkish. There were some hawkish things about them, like the word disinflation, for example. The market just loves that disinflation word. Well, the disinflation word didn't appear anywhere in the Fed minutes. So the fact that disinflation was taken out, maybe that disappointed the Pivoteers a little bit, the people who were hoping to have the Fed pivot just any day now. They didn't get that. There was the usual lip service was paid to how the Fed was unified and committed to fighting inflation, right? Everybody was expecting that. So that wasn't particularly hawkish. That was what everybody expected. Now, they did mention that virtually all of the participants were in favor of the 25 basis point hike that we got. No big surprise there. And then they mentioned that a few participants advocated for a 50 basis point hike. The word few kind of tells us nothing, right? We knew Bullard wanted the 50-point hikes, and there was a couple of other Fed governors had been in the press saying, let's just get to where we're going as soon as possible and then wait. But when they said a few, they didn't give the market the clarity they wanted, so it's not like it was particularly hawkish. So really, Fed minutes were just nothing. They didn't do anything, and I think the market was kind of hoping for a little bit of dovishness in the minutes, and they didn't get it. So that's why stocks sold off a little bit yesterday. Now they're getting it all back today. My guess is that's because of those NVIDIA earnings. We'll talk about that in a minute. NVIDIA stock is running like the blazes this morning. With that, let's shrink my big melon of a head and see what is going on in stocks this morning. We have got the S&P is up about 0.7% or 27 points, currently at 4,019. We've got the Dow is up 121 points or 0.37% at 33,166. And the NASDAQ leading the way higher, up almost a full 1% or 112 points at 11,620, although currently giving up some of those gains. So stocks open sharply higher this morning. We'll see if they stay there. Over on the dollar front, the DXY is essentially flat this morning. It's down 10 basis points, but still around that 103.50 to 104.50 range that it's been in for a couple of weeks, currently at 104.47. See where the dollar goes from here. Not any big moves happening in currency markets this morning. And looking over at the bond market right now, looks like the 10-year yield is pretty much flat right now. We did see a slight recovery yesterday. Yields were down a couple of basis points to start the day. They crept back up and stayed up a couple of points higher after the release of those minutes. Again, the market, I guess, interpreted the minutes as mildly hawkish or at least not dovish. That was enough to send yields a little bit higher yesterday. Right now, the 10-year is at 3.92. I am expecting it to go to 4 and then probably take a break there. Let's see. Elsewhere in the curve, not a whole lot happening anywhere. A couple of basis points here and there. Not much happening in bonds today. In the commodity space, we have got gold at $18.32, down about $9 right now, or about 1/2%. Silver's down a dime at $21.57, down about 1/2%. WTI crude up $1.74 or 2.35%, currently trading at 75.72. We'll talk about oil in just a second. Natural gas at $2.41, up 11 cents or 5.18%. Now, let's talk about oil and gas, because yesterday we got API crude oil stocks change came out. That's the American Petroleum Institute. These are private sector numbers. Another massive inventory build for oil in the United States. We are not burning much oil here, folks, which some people are out there saying, good, that's great, we shouldn't burn oil, the planet. Yeah, I get that. But at the same time, no oil burning means no things happening. That means people not working, economic activity not taking place. All right, the energy transition didn't suddenly become successful overnight. We just stopped using so much energy. Stocks of crude oil in the United States jumped by 9.9 million barrels in the week ended February 17th. Following a 10.5 million barrel gain in the previous week. So what's going on? We're just not burning oil, folks. That's what's going on. Now, this is several months in a row where both the API numbers, private sector, and the Energy Information Administration, the government numbers, have all said big inventory builds for oil. We're just not burning oil. And look, U.S. oil production is still 800,000 barrels per day below pre-pandemic levels. So we're building an oil inventory. We stopped dumping the SPR. That's not where this oil is coming from. We're not pumping as much oil out of the ground as we were before everything went to hell in a handbasket. So we're just not experiencing that much economic activity. And I don't care what you do to the unemployment numbers, what you do to the GDP numbers, you can't fake energy consumption. And the energy markets are telling us right now this economy is slowing. Looking over at the oil chart, we have been kind of range bound here. I changed my lines up a little bit today. We've been in this range between about $71 and $80 really since November. Right now, we're at the lower end of the band, catching a little bit of a bounce today. So what is this optimism in energy about today? Well, I saw this story in Bloomberg, and talk about rose-colored glasses. Look at this headline. Ready for liftoff as China reopens, according to Bloomberg Trade Tracker. Oh, ready for liftoff. This must be economic prosperity. Well, no, not really. I mean, look at the way this starts. Easing supply chain disruptions and increased trade volumes are lifting the global outlook ahead of the highly anticipated boom that should come from China's reopening. Okay, that's great. That's very optimistic. But then next sentence, the relief started only slowly in the trade picture, with 8 out of 10 indicators on the Bloomberg Trade Tracker hanging in negative territory as of February 17th, a very slight improvement from 9 at the start of the year. So, I mean, they've got this rosy headline, ready for liftoff and booming China trade, when the only thing that's happened is instead of 9 out of 10 of these indicators being negative, 8 out of 10 are negative. Wow, what an optimistic shift. Well, that's the rose-colored glasses. That's the financial press. There's a lot hanging on this China reopening. There's lingering gloom over the outlook, with business sentiment across the U.S. and Europe remaining sour. Manufacturing hubs Taiwan and Korea are also posting persistent export slumps. That all sets the stage for a rebound when China fully reopens. So that last sentence there, that all sets the stage for a rebound when China fully reopens. The market is pinning all of its hopes on this China reopening. Better hope this reopening works and that it goes well, because otherwise this ready for liftoff ain't happening, folks, because it's not going to be the U.S. and Europe that lifts us out of this global recession. I can tell you that. Looking over at natural gas, natural gas just cannot catch a break. I mean, it's up a little bit today, but still $2.41 in natty gas futures, currently butting up against that 9-day moving average. I still have no position in natural gas, although we could be seeing signs of a bottom here. Check this one out in Reuters, dated this morning. Chesapeake Energy to reduce drilling amid nat gas price slump. Well, we've now had enough demand destruction that it's starting to affect the suppliers, who are starting to produce less natural gas because of that demand destruction. So this could mean a bottom is near. When you see less capex, less investment happening, that means tighter supplies in the future. Maybe this is enough to find a bottom in natural gas. Chesapeake said it will drop 2 rigs in the Haynesville region that covers parts of Texas, Arkansas, and Louisiana this year, and 1 rig in the Marcellus Shale of Pennsylvania and West Virginia. We certainly see that it's prudent to pull back capital, and we think we're seeing others do the same, said Chief Executive Nick Deloso. He said energy firms are pulling back in the shale gas play in Louisiana and East Texas. We're making money on the capital that we're investing, but the margins are not nearly on a full cycle basis what they were historically. So we're seeing now supply destruction happening because the demand destruction has been so bad. All right, that's the energy story. The big one driving stocks this morning was NVIDIA. Again, rose-colored glasses, I have to say. And look, full disclosure, I wear it on my sleeve here. Perma Bear. I get it. I don't really do optimism, but you guys tell me if I'm reading too much into this. NVIDIA stock rises after a slight beat driven by AI chips. NVIDIA stock rose on Wednesday after the company reported slightly higher revenue and net income than Wall Street had expected, despite a year-over-year decrease in both categories. Year-over-year decrease in earnings and revenue, and yet the stock is running. Data center revenue, which includes AI chips, increased 11% on an annual basis to $3.62 billion. And that's the thing. NVIDIA is just like your trendy chip stock. Whatever is trending, NVIDIA makes it. And that's why everyone's like, pile into NVIDIA. And Jim Cramer named his dog after the company. Oh, Bitcoin's not really a thing right now. Well, forget about their graphics processors. Oh, AI is all trendy now. Well, NVIDIA makes chips that will benefit from AI. So after a slight beat, even though a year-over-year decline in earnings, NVIDIA stock right now up 12% this morning. Good God, that is a big run for a company that just posted a year-over-year decline in both earnings and revenue. Talk about low expectations. All right, one more thing I want to talk about here. We have got the CME Group. This is the Fed Watch tool. After yesterday, when the Fed minutes came out, there was a 21% likelihood of a 50 basis point rate hike in March. And then after the meetings came out yesterday, after those minutes, it went from a 21% likelihood up to a 27% likelihood. So markets right now, again, back to the Fed minutes, they're interpreting it as mildly hawkish, the minutes, although I don't think they were really that hawkish. They just weren't very dovish. So a slightly higher chance of a 50 basis point rate hike. Again, Fed is going higher. Fed is going to be there for longer. Also, real quick, I just want to mention here, we've got the number of Americans filing unemployment benefits for the first time. Initial jobless claims fell by 3,000 again this month to 192,000. So all these stories about layoffs, they're not showing up in the jobless numbers yet, folks. They're just not there. 192,000 initial jobless claims down from 195 the previous week. We're seeing the same thing in continuing jobless claims. A big drop in continuing claims from 1691 down to 1654. So the labor market, at least on the surface, is still tight. Although I would point out that most of the decline in initial jobless claims came from California and New York. Little suspicious there, just a little bit. I'm not going to insinuate anything, but those are the states that people can't seem to get out of fast enough. And they're also the states seeing the biggest decline in jobless claims. Take from that what you will. Also on the jobless front today, we've got NPR becomes the latest media outlet to cut jobs. Interestingly enough, an article in NPR about layoffs at NPR. How'd you like to be the guy who has to write the article about your own job getting taken away? Well, that's interesting. Anyway, NPR's chief executive announced the network would lay off roughly 10% of its current workforce, or at least 100 people, not a huge amount of layoffs, and eliminate most vacant positions. The CEO cited the erosion of advertising dollars, particularly for NPR podcasts, and the tough financial outlook for the media industry more generally. We've got another story about layoffs. McKinsey to cut 2,000 jobs in one of its biggest layoffs. McKinsey is a consulting giant. They're planning to cut 2,000 jobs in one of the biggest round of layoffs. Bloomberg reported Tuesday, citing people with knowledge of the matter. There's another anonymously sourced article. I love this trend of anonymous sources. The report said the move is expected to focus on support staff who do not have direct contact with clients of the company, known for advertising businesses on a variety of projects, including layoffs. So the company that does layoffs is laying off people. Talk about your mind-blowing irony. All right, guys, it looks like right now stocks are set to have a halfway decent day. We'll see if that one holds up. I want to thank you guys for your time watching. Thank you to my Patreon supporters. Oh, wait, I forgot my Patreon meeting is today at 1 p.m., Link down below should you feel so inclined. And where are you? I know Steve was in here somewhere. I don't want to miss your super chat, Steve. I'm sorry. Oh, my goodness. You guys are active in the chat this morning. There is my man, Steve Hoytis, said, with a squeezed consumer due to high interest rates and inflation, where is the demand going to come from to drive the China reopening? Steve, that is an awesome point. Awesome point. People in America have no money left after paying for food, fuel, and shelter for the week. So who's going to buy all this Wish.com crap that supposedly China's going to start cranking out now that their reopening is there? That is a fantastic point. It is not going to come from the American consumer. I can tell you that. The American consumer is up to his eyeballs in debt. He's out of savings. His wages aren't rising, and the interest rates on his debt are rising. So this China reopening, Steve, let me just say, besides thank you very much for the support of the channel and for the super chat, I share your skepticism that the China reopening is going to be this boom to the global economy. I really do. It may see a slight uptick in oil consumption, but I really don't think it's going to be that big. I don't think the orders are going to be there to justify this sudden surge in manufacturing again. But thank you very much, Steve. I appreciate the super chat, sir. Thank you, everybody, for your time, for watching. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.